Hey guys, it's your boy Seth and Paul. Thanks for watching the Everything Money channel. Today we talk about Facebook stock. Paul, get after it. Should or should we not buy Facebook stock?
What should they do before we do this?
Good question. Make sure you smash that like button right below to support the channel. And
it allows me to pay Seth and Don more money down the road. It allows us to figure out which videos you like, which ones we're going to create more of, yada, 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 yada.
What is Facebook worth and what should I be paying for it?
All right, so the reason we picked Facebook is it's a high-flying stock right now. Everybody is in love with it. It has a lot of great potential, but I want to make sure that we figure out not exactly, but a general idea of what we're going to pay for it. So in one of our previous videos, we talked about what we look at from a high level for every stock. So we're going to do that again here today. So first off, the other thing is, this is all my opinion. I'm not telling you to buy stock at any price. I'm just telling you this is my opinion. The stock is probably selling for a higher price than I think it's worth. If it ever falls to that, it could fall for many reasons, one of which any of the things we talk about here today could have changed. So that's my disclaimer that legal makes me say. So right now, one of the things I look for in any stock I buy is growth. Is it growing? Do I want a lot of growth? Do I want a little? It all depends. But one thing is, you look at Facebook's revenue over the years, since 2010. What's going on here, Seth?
1 billion, 3 billion, 6 billion, 11 billion, 17, 26, 39, holy cow, $69 billion.
So they went from $1.8 billion to $70 billion in revenue in a 10-year period. That's pretty impressive. That immediately tells me I'm already going to be apprehensive saying, oh boy, it's a fast-growing company. People are going to love it, thinking this growth will continue on forever, and it won't. And that's the big mistake everybody makes. But the point is, it's growing and it's growing well. Next I go to is profit. Let's see the profit numbers, Seth. You want to rattle them off?
600 million, 1 billion, 53 million, 1.5, 2.9, 3.6, 10, 15, 22, and then back down to 18 billion.
So their profit is going up astronomically as well, right?
Yeah.
So it keeps going up, revenue keeps going up. They're doing a good job of making money. That's a very positive sign. I love it. I'm going to move on to my next step. So then I go to the balance sheet. So the balance sheet, this is where you get the snapshot of the company. It tells you at this second of time that we're looking at, what's in the company's assets, what's in their liabilities. Assets being the stuff they have, liabilities being the stuff they owe. I always want to look at that to see, it'll tell me how healthy the company is and can it withstand. Do they have too much debt? Do they have too many assets they're not deploying, etc. So one of the things I look at is total current assets. Total current assets is how much basically money they have on hand at any given time. As of December 2019, they had $66 billion in total cash, essentially. That includes cash, receivables, all that stuff. That's a lot of money. That's money they can convert very quickly into cash in their pocket, $66 billion. And as you see over the years, it's increased quite nicely over the years. So this is a company that does a good job of hoarding their cash, which I love, okay?
What about what they owe?
Now, what they owe. Current debts, money they owe in the short run. $15 billion.
They have 4 times that
They
sitting
have
around.
over 4 times that amount of money in their bank account. So right now, it's like you at home have $100,000 in your bank account and you owe $25,000 in immediate bills. Are you worried about paying your bills?
No.
You are not at all.
Not
That's
just my
wonderful.
bills, though. This includes my house and my car?
No, not yet. That's just total current liability. That's money in hand.
Okay.
And that's bills in hand, like your
Gas,
car
water,
payment,
electric.
your gas, your electric, your mortgage payment, your rent payment, things that are due in the next 30 days very quickly. These are actually in the year, but either way. So from here then, Seth, I will go down to total liabilities. Now here's the impressive part. Total liabilities is all their debts, all their stuff that they owed right now, their payments, their electric, utilities, rent, plus the total mortgage, the total car note to pay off the entire car note, all your bills, everything that you possibly owe.
32 billion, half of what they have in hand.
So they have twice as much money in their bank accounts as they owe as an entire company. So as an example, to bring that into your personal situation, that's like you have $100,000 in your bank account and your entire you would pay off your house, your cars, your credit cards, your current bills, everything, and still be left with $50,000 in your pocket.
Seems incredible.
Are you going to go under doing that?
Seems pretty healthy.
Very healthy. So if I'm an investor, I love seeing this. This is a company that's probably going to be around for a very, very long time. There is a slight red flag in all this. Their total liabilities have jumped up a lot. It's gone up by 2.5 times in the last year. That is something that I would look at later. But even right now, I'm okay with this because of how much money they have on hand. So I'm looking at this going, okay, let's go to the next step. Next thing I do is I go to the statement of cash flows. Now again, guys, this is very high level from my standpoint. From the average investor standpoint, your financial managers, your so-called experts aren't even doing this. Whenever I talk to financial planners, they don't know what's going on behind the scenes, and it takes 2 seconds to look at it.
Where can normal people find this information?
Great question. I use a thing called Y charts. It's expensive. It costs money every year, but all of this information is publicly available at the SEC, Yahoo Finance, Google Finance. Any free finance website will give you all the information you need, even going to the individual companies that will give you this information.
I assure you, if you comment below, Paul will personally answer questions if you have about stocks and stocks and investing. So the statement of cash flows, what I want to look at is how much cash they generate. It's you calculate it by taking their cash from their business, their operating cash flow. That's the money they make, the cash flow they make from operating their business, and taking out their capital expenditures. Their capital expenditures are basically their reinvestment back in their business to help it grow. So last year, they did $21 billion, $36 billion minus 15. If you look at the previous years, they're always in the positive by a big number. They don't spend as much as they could on their business. They generate a lot of free cash flow, as it's called. Why is free cash flow important? I have no idea. Tell me.
Because this is the money that they're going to use to grow their business, to pay dividends, to buy back shares, to make you as an investor wealthier. There's a lot of people out there who invest purely based on free cash flow. I like to look at free cash flow more than I look at net income because that's actual cash in hand. That's not like, I don't want to get into it, but net income can be high. You can have high profit without cash flow and vice versa. You can have a loss with high cash flow. The cash flow is actually the money that goes in and out of the accounts. So you want to be able to understand, is that a good number? And is it going to be able to pay and grow the business, pay the investors and grow the business? That's an important aspect. So,
how does all this relate to the price of the stock and whether you should or shouldn't buy?
Great. So, the next thing I look at is now the metrics. And this is where we get the wah.
Here, look at
it's
that.
selling for 33 times earnings. Their PE ratio, as we've all learned, price to earnings ratio is 32.
Explain PE one more time.
That means for every dollar of profit, you have to pay $32 for that. The historical average for companies is 15. So it's over double. Now, does that mean it's not a good buy? Listen, it's a fast-growing company. If profit doubles in a year, that 32 becomes 16. Not bad. It is fast-growing. It is increasing its profit. And this is where the art of investing comes into play. Now you have to look at the company on its qualitative aspects. When I say qualitative, that's versus quantitative. We looked at the quantitative aspects already, the actual numbers. What do they mean? The actual numbers and what they show. The qualitative aspect is, okay, what does it mean? How are you going to sit there and use that information and the company's information to determine if this is a high price or not? Me personally, it's hard for me and a company as big as, right now, they have the company worth $675 billion. I have a hard time thinking that a $675 billion company has a lot of room to grow.
Yeah, room to grow.
The most expensive company in the world is $1.4 trillion, just double that. So for this to double in the next year or two or three, it's just going to be a hard thing. Does that mean it's not going to happen? No, it could very well happen, but it's a hard proposition.
So you need that PE ratio to be much lower. And
Absolutely.
The only way to do that is if they make more money.
Absolutely. Now, there are other positives. Their gross profit's 81%. What does that mean? For every extra dollar that comes in, it's 80 cents of that to the bottom line. This is the actual marginal profit on every dollar that comes in extra. And their bottom line profit is 28% after taxes. So for every dollar they made last year, 28 cents of it went to profit after taxes. So this is a company that not only grows fast, but they're able to make a lot of money. And it's going to be hard to kick Facebook off its throne. It kicked MySpace off its throne, but MySpace wasn't making any money. So you look at this saying, Facebook is probably going to be one of the big tech stocks for a long time. They're trying to become, they have Instagram, that's doing well. They're trying to become a big tech company that does a lot of things. They bought Oculus, that virtual reality company. They're not just trying to be a social media company. They're trying to be a company where everybody goes to for their living of their life. They're trying to ingrain themselves into everyone's lives. So that's a very big positive if it's able to work, but that's all the more reason why if they're able to pull it off, yeah, that's great. But if they're not able to pull it off, you have to wonder how much you want to pay for that. So I look at Facebook and I think to myself, am I willing to pay this? Do I think it's worth that, quote unquote, not risk, but the price? It is a great business, and I don't think it's a great price. I think it's an okay price. Is it justifiable? Yes. But would I be paying, what's it at right now? Would I be paying $237 a share for it? No. From the 500-foot view, and I haven't run my numbers, I have an Excel sheet that runs all these projections and like that, my guess is Facebook's probably worth $150 at most to me per share. Now, the great news is, if you look at this year, it was at $150 this year. I should have bought it. I wasn't paying attention. And that's my fault. I should have been paying attention to these prices going, oh my God, it was at $150 just 2-3 months ago. So as you see, prices will fluctuate and prices can fall. I wish I'd bought them because I think Facebook is the one place where their revenue is going to keep, they're going to have increases in profit even with a recession. I still think their profit and revenue go up because they're still able to drive up a lot of revenue and profit. So I personally believe Facebook, as of June 9th, 2020, is worth about $150 a share.
Smash that like button below. Follow the Everything Money channel. Paul will be doing this all year long. We're committed to this. And Paul, great analysis. Keep it up, bro.
We cannot stress enough. Even if you dislike, tell us why. We will comment. We'll respond.
Thanks, guys.